this video, we're going to be talking about 5 signs that you might be a bad, potentially even a terrible investor. Now, why would I make an investment video, or why would I make a financial video pointing out that you might be a bad investor? Because in life and in investing, knowing what you're good at and knowing what you're not good at can actually help you tremendously and save you a lot of mistakes and a lot of pain later on. In a sense, being self-aware is critical to any success in life, and it's definitely true when it comes to investing. And I know because I've been an investment advisor for over 20 years. Prior to that, I was investing my own money for 10 years before I became a professional, and I've made my share of mistakes. So this experience that I'm going to share with you is drawing both on my own personal mistakes before I really learned what I'm good at and what I'm not good at, as well as the mistakes that I've seen many others make in my over 20 years in advising high net worth investors. Now, everybody knows that making investment decisions is already a challenging exercise, but recognizing when you might be making mistakes can actually help you to improve your strategy, to reach your financial goals more quickly, and to make sure that the probability of you achieving your goals is as high as possible. So one sign that you might be a bad investor is that your portfolio is either too concentrated or not properly diversified, given the amount of knowledge and research that you've put into your different investments. So what does this mean? One of the most common mistakes that bad investors make is failing to diversify their portfolio sufficiently. Now, diversification means that you have enough variety in your portfolio so that if you make some mistakes, or when some of your holdings zig while others zag, your entire portfolio does not suffer potentially catastrophic losses. So one way to diversify appropriately is to have some exposure to different types of assets in your portfolio, assets such as stocks, bonds, and real estate. This helps reduce risk by ensuring that a loss in one area can be offset by gains in another. If you find yourself consistently investing, let's say, in 1 or 2 stocks based on stock tips, it may be a sign that you're violating this first warning sign and that you may therefore be a bad investor. Now, one caveat to this is that the more you know, the more time you spend understanding your investments, the greater the concentration that you can actually have in your portfolio without being a bad investor. Sign number 2 that you might be a bad investor, which I see all the time, is that you're chasing returns instead of thinking proactively about the future. So chasing returns is another red flag that you see all the time. And what this means is that you're investing in different opportunities based primarily on their past performance instead of thinking carefully about what their future holds. The reason is that past performance of investments is often not predictive of how they're going to do in the next period of time. And this can be particularly true when the past performance has led to that particular investment being overvalued or extremely popular in the marketplace. Instead of looking at past performance, you should be doing your homework, doing your research, thinking carefully about the current risk, the current volatility, and the long-term opportunity that a given investment offers. Bad investors, on the other hand, often fall into the trap of buying high and selling low. Thereby, they miss out on opportunities to earn steady returns over time by being more patient and more long-term oriented. Danger sign number 3 that I've seen all the time, it might actually be probably the most prominent sign that someone may be a bad investor, is emotion-based investing. What this means is that you're making investment decisions based on emotions such as fear and greed, rather than logic and research. About a year and a half, 2 years ago, towards the beginning of the pandemic, we saw a lot of people who were buying and driving up companies like AMC and some of those other popular stocks. More recently, it's Bed Bath & Beyond. And a lot of people are doing this based on emotion. You know, they were angry at people who might have contributed to the financial crisis. They wanted to punish some hedge funds just to feel better. And so they were basing their decisions more on emotions and more on popularity, coordinated in these forums like Wall Street Bets, rather than using their own logic and their own thinking. By making emotional decisions, these people were almost guaranteeing themselves to be entering into speculative activities, thereby tipping the scales against them succeeding in the long run through their investments. And you see emotional-based investing all the time, not only in terms of chasing things that are working, but then when inevitably markets fall and there's panics like we've seen at times, including this year with tech stocks falling, people get very scared, and again the emotion of fear kicks in and they sell good companies or good investments at panic times and at prices that are very low. So for example, selling stocks in a panic during a market downturn or buying a stock just because it's gone up in value are both examples of emotional investing and are both signs that you should be careful because you may not be a great investor. Sign number 4 that you may not be a great investor is ignoring fees and expenses. This is a pretty common mistake made by investors. Many investors don't realize the impact that fees and expenses, as well as taxes, have on the returns that they can generate over time. This relates to some other videos which I've made about the power of investment compounding, and fees and expenses and taxes are all forces that fight against the power of long-term compounding. So taking time to understand the level of fees, expenses, and taxes that a given investment or investment strategy or investment approach might entail is extremely important. And one great example of people who don't sufficiently take fees and expenses and taxes into account is, for example, about more than 10 years ago, but even today, there's a lot of people that engage in day trading. And what they probably don't factor in enough is how expensive day trading can be when it comes to trading fees and transaction costs, as well as taxes that are generated on gains. So remember, it's important to consider the cost of investment products and to choose low-cost options whenever possible, and that includes low-cost strategies as well. And sign number 5 that you may not be a great investor or you may be a bad investor is not having a long-term plan and a long-term investment philosophy, being too short-term oriented and really being somewhat rudderless in your approach to investments. Because a clear goal and a clear strategy working towards that goal and having a solid strategy of buying and holding assets for the long term, this is a commonality that you see with almost all successful investors. A solid long-term investment plan helps you stay focused and disciplined. And focus and discipline really are critical to increase your chances of success, especially in the long run. So there you have it. Those are the 5 signs that you might be a bad investor. I urge you to look at your past investment results and your past actions and the way you think about investing to see if you make any of these mistakes, one or more of these mistakes. Because recognizing that you're making mistakes is the first step in becoming a much better investor. And if you do find yourself making these kinds of mistakes, it's time to reassess whether you should be pursuing the investment approach or the investment strategy that you may be pursuing. And perhaps even more importantly, not everybody is cut out to be their own investment manager, especially if you're making one or more of these mistakes, in which case it might be more productive or fruitful to seek out the help of someone who is more equipped to take the burden off of you and help you get much better investment results than you might be capable of getting on your own. Hope you liked this video. If you did, please like and subscribe, and see you next time. Check out some of my other videos where I cover a bunch of other topics around investments, finances, and personal success. Thanks.